Welcome to Finance Frontier, part of the Finance Frontier AI series. This is where we break down the forces shaping global markets, trade wars, economic power shifts, and financial strategies that move the world. Whether it's trillion-dollar debt crises, historic market shifts, or the next great financial reckoning, we analyze how money, policy, and technology collide.
What if I told you the biggest financial crisis of the decade is happening right now, right under our noses? Washington is running out of time. The debt markets are flashing warning signs, and the risks are piling up. The 2025 debt crisis isn't just another round of political theater. It could be the moment global investors lose faith in the U.S. economy.
The numbers are staggering. U.S. national debt has now surpassed $36.1 trillion. And here's where it gets worse. $9.2 trillion of that debt is set to mature in 2025 alone. That means the government isn't just borrowing more, it has to refinance massive amounts of existing debt at much higher interest rates.
If Congress doesn't act fast, this isn't just a political problem. It's a full-blown global financial crisis waiting to happen. We're talking about a potential collapse in U.S. leadership, a shift that could destabilize the global order. When the world starts doubting U.S. debt, it's game over.
I get it, Max. Things look bleak. But let's keep the big picture in mind. Yes, we could face a crisis, but we've seen this before, and the U.S. has always bounced back. What's more likely is that we'll see a bumpy ride, but the global economy won't let the U.S. fail. There are other players involved, and the world's economy isn't just dependent on Washington anymore. And if you're thinking, haven't we been here before? Yes, but never like this. The U.S. has faced debt ceiling fights before, but this time the stakes are higher, the options are fewer, and the risks are global. If Washington fails to act, we could see massive interest rate spikes, a credit rating downgrade, and a market sell-off, unlike anything since 2008.
This isn't a drill. The warning lights are flashing, and history tells us that financial crises don't happen overnight. They build up, then suddenly explode. We're breaking it all down today. Why this crisis is different, what happens if Washington fails, and how this could affect your money, your job, and the future of the global economy. We'll also dive into what smart investors are doing right now to protect themselves.
And in case you're new here, I'm Sophia Sterling, data-driven, strategic, and always 3 steps ahead.
And I'm Max Vanguard, bold, fast, and built to decode high-stakes financial shifts.
And together, we're cutting through the noise to bring you the facts, the risks, and the real financial power plays shaping the future. Let's dive in.
Before we jump in, make sure you're subscribed on Apple Podcasts, Spotify, or wherever you listen. And if you find this episode valuable, share it with a friend. It's the best way to help us grow and keep bringing you deep financial insights. You can also follow us on Twitter for daily updates on the biggest market trends. So let's talk about how we got here. The U.S. has had debt ceiling fights before, 2011, 2013, 2023, but this one's different. The national debt has ballooned to $36.1 trillion, and unlike past fights, there's no easy way out this time.
For years, low interest rates made borrowing cheap. The U.S. kept running deficits, but it didn't seem like a big problem because the cost of debt was minimal. Now, Treasury yields have surged, and refinancing costs are skyrocketing. The government has been using emergency measures since January 2nd to keep operating, but that can't last forever.
And here's where things get even more dangerous. $9.2 trillion of U.S. debt is maturing this year. Asterisk. That means the government isn't just borrowing more money. It has to replace massive amounts of old debt at today's higher interest rates.
And here's the real kicker. Foreign investors are pulling back. Foreign holdings of U.S. debt dropped from $8.679 trillion in September 2024 to $8.513 trillion in December 2024. China, once one of the biggest buyers of U.S. treasuries, has cut its holdings by $9.6 billion, down to $759 billion as of December 2024, the lowest level in 12 years.
And when demand weakens, borrowing costs rise. If investors start losing confidence in Washington's ability to manage its finances, they'll demand even higher interest rates to lend money to the U.S. That means more expensive mortgages, higher credit card interest rates, and rising costs for businesses. And that can slow the entire economy down.
And that's why this crisis is different. This isn't just about Washington arguing over numbers, it's about whether the entire financial system can handle the US government's debt burden. If they get this wrong, the fallout could be catastrophic.
So if Washington fails to act in time, what happens next? What's the worst case scenario? That's what we'll break down next. Let's be blunt. If Congress fails to reach a deal, this crisis won't just be a political showdown. It could trigger a global chain reaction. Markets tank, credit dries up, and investors start questioning whether the U.S. is still the world's safest bet. The shockwaves wouldn't stay in Washington. They'd ripple through every financial hub on the planet.
The first thing to go? Confidence. Investors don't wait until a default happens to react. They start moving their money the moment they sense risk. That's why Treasury yields are already rising as concerns about U.S. debt grow.
And when Treasury yields rise, borrowing costs go up across the board. That means higher mortgage rates, higher credit card interest rates, and higher business loan costs. Everything becomes more expensive.
And it won't just hit households. The federal government has massive obligations: Social Security checks, military salaries, Medicare payments. If the Treasury runs out of options, these payments could be delayed or reduced.
And we've seen what happens when confidence in the U.S. government's ability to pay its bills takes a hit. In 2011, a debt ceiling standoff led to the first ever U.S. credit downgrade. Markets plunged, and it took months to recover. Now, with a much larger debt load, the consequences could be even worse.
And let's not forget the economic risks. Moody's Analytics ran a model for a potential U.S. debt default, and the numbers are staggering. If the U.S. defaults for just a few months, we could see a 4.6% drop in GDP, 7.8 million jobs lost, and $10 trillion in household wealth wiped out. This would be one of the most catastrophic financial events in modern history, worse than the 2008 financial crisis.
And that's where things get dangerous. If interest rates spike too high, the government could be forced into drastic spending cuts, which could trigger a recession. It's a domino effect. One bad decision in Washington could set off a financial shockwave.
And the worst part? Markets won't wait. If they believe Washington won't get its act together in time, they'll start pricing in a crisis before it even happens.
So if this isn't just political theater anymore, what's the real endgame? Can Washington still prevent a financial disaster, or are we already past the point of no return? That's next. We've talked about how the debt crisis could spiral out of control. But let's take a step back. How did we even get here? How did the U.S. go from manageable deficits to a national debt so large that even a minor interest rate increase sent shockwaves through the economy?
Decades of overspending, combined with an era of ultra-low interest rates, created a perfect storm. The U.S. borrowed trillions when rates were near zero, assuming the cost of debt would remain low forever. Now, Treasury yields are climbing, and the government is paying more to borrow money than at any point in modern history.
That's the key. In the last decade, Washington took advantage of low borrowing costs. But now, those old bonds are maturing, and they have to be refinanced at much higher rates. That means the U.S. could be paying over $1.2 trillion per year in interest alone by 2026. That's more than the entire defense budget.
And the numbers don't lie. In 2024, the U.S. spent $870 billion just on interest payments. That's more than the entire defense budget. And with rates still rising, that number is only going one way up. Investors are watching every move Washington makes, and if they sense weakness, confidence in U.S. debt could start unraveling faster than policymakers can react.
That's what makes this different from past debt fights. In 2011, when the U.S. lost its AAA credit rating, the national debt was $15 trillion and interest rates were near zero. Today, debt has more than doubled, and borrowing is far more expensive. That means the financial consequences of inaction are far greater.
And global confidence is slipping. China, which once held over $1.3 trillion in U.S. treasuries, has reduced its holdings to $859 billion, a 12-year low. Foreign investors are slowly pulling back, and the more they sell, the harder it becomes for the U.S. to borrow at sustainable rates.
The warning signs are flashing, and history tells us that ignoring them comes at a price. So, what do the lessons of past crises tell us about how this could unfold? We've seen debt crises before, but this time the scale is much bigger. In 2011, we saw a major standoff in Washington that led to a credit downgrade and a market sell-off. The difference now? The U.S. has more than twice as much debt, and borrowing costs are soaring.
That's what makes this crisis more dangerous. When the US faced economic turmoil in the past, it could always borrow cheaply to stabilize the situation. But now, interest rates are rising, and the ability to borrow our way out of trouble is disappearing.
And let's not forget historical warnings from other countries. Japan has been stuck in a cycle of massive debt and low growth for decades. Argentina has defaulted multiple times after relying too much on borrowing. The U.S. isn't there yet, but if debt continues to spiral, we could be heading down a dangerous path.
And here's the big question. What happens when the world stops seeing US debt as a risk-free asset? If investors begin treating treasuries as a growing liability instead of a safe haven, borrowing costs could surge and a financial reckoning could follow.
History tells us that no empire stays on top forever. The U.S. dollar has been the backbone of the global economy for decades, but dominance isn't a given. If major economies like China, India, and the EU accelerate their move away from the dollar, we could be witnessing the slow erosion of U.S. financial power. And once that shift gains momentum, reversing it becomes nearly impossible.
And we're already seeing signs of that. More countries are settling international trade in currencies like the yuan and euro, reducing reliance on the US dollar. This shift may be slow, but it's happening. If confidence in US debt continues to decline, the move away from the dollar could accelerate.
That's the warning sign Washington needs to pay attention to. If foreign investors and global markets start treating U.S. debt as a long-term risk, we could be looking at a very different financial landscape in the next decade.
So, is Washington finally taking this seriously, or are we about to see another round of political brinkmanship that pushes the global economy into a deeper crisis?
So we know how we got here, but what happens next? Are we looking at a slow unraveling, or is this crisis about to hit all at once? And more importantly, can Washington stop it before it's too late?
Investors aren't waiting for a government resolution. They're already adjusting their strategies. Gold is holding steady around $3,000 per ounce, and Bitcoin is seeing renewed interest as a hedge against financial instability. Investors are shifting away from riskier assets and looking for safer options.
That's the key. U.S. Treasuries have always been considered the safest investment in the world. But with foreign investors like China pulling back, holding only $859 billion, its lowest level in 12 years, markets are wondering if Treasuries still deserve that status.
And it's not just investors. Businesses that depend on government contracts, defense firms, healthcare providers, and infrastructure companies are already warning about potential delays in payments. If Washington drags this out too long, entire industries could see cash flow disruptions.
And here's where it gets really dangerous. If foreign demand for treasuries weakens too much, the Federal Reserve could be forced to intervene, buying up government debt to prevent a collapse. That's exactly what Japan has been doing for years, and it's led to decades of stagnation.
The Federal Reserve is in a tight spot. If they keep cutting rates to stabilize the market, they risk reigniting inflation. But if they don't, they risk letting borrowing costs spiral out of control. Either option carries huge risks for the economy.
That's the trap. And with Washington still deadlocked, the question isn't just whether we can fix this. It's whether we've already crossed the point of no return. Public reaction to the debt crisis is split. Some believe Washington will pull off another last-minute deal like always, while others think this time is different. But the system is stretched too thin, and a real financial reckoning is coming.
And that divide isn't just among everyday investors. On Wall Street, hedge funds and institutions are already adjusting their strategies. Gold is holding around $3,000 per ounce, and Bitcoin is seeing renewed interest as a hedge against financial instability. Public concern is growing. Sentiment on X, Twitter, shows that many are fearing a U.S. default, especially as the debt ceiling debate drags on. People are increasingly worried that we could see a default by summer, with some predicting severe market consequences if this continues.
And let's talk about investor warnings, because they're getting louder. Some analysts think this is just another Washington showdown that will get resolved at the last minute. But others, like billionaire investors Stanley Druckenmiller and Ray Dalio, aren't buying it. Dalio has been warning that without major changes, the U.S. could face a full-scale economic heart attack within the next few years. But what if this crisis is exactly what we need? What if a financial shock like this forces the global economy to fix long-term imbalances that have been brewing for decades? A reset, as painful as it may be, might actually set us up for a more stable future.
This isn't just an internet debate. Real-world consequences are already unfolding. Credit rating agencies are on edge, and if Washington drags this out, a downgrade, like the one we saw in 2011, could hit again. And here's the kicker. The last downgrade triggered a market sell-off, but this time, with debt at record highs, the damage could be far worse.
And here's where the real danger lies. Once confidence in U.S. Treasury starts to slip, it becomes incredibly hard to reverse. If something similar happens to U.S. Treasuries, the consequences will be global.
And let's not forget inflation. If foreign demand for U.S. debt weakens and the Federal Reserve has to step in and monetize more of the debt, that could reignite inflationary pressures, just as the Fed has been trying to bring them under control.
And that's the trap. If the Fed lets interest rates rise too much, it risks crashing the economy. But if it prints more money to absorb government debt, it risks long-term inflation and a weaker dollar. There's no easy way out of this.
That's why this isn't just about politics. It's about whether the entire financial system can function under this level of debt. And more importantly, what happens if markets stop believing Washington can manage it?
Which brings us to the final question. What happens next? Can this crisis be solved? Or is the U.S. heading toward a financial reckoning that no one is prepared for? So where do markets stand right now? Are we looking at a full-blown financial meltdown, or is this just another round of debt ceiling brinkmanship that investors will eventually shrug off?
Right now, smart money is already making moves. Gold is holding steady around $3,000 per ounce, and investors are shifting into safe haven assets. Treasury yields are rising as demand for U.S. debt weakens. If Congress drags this fight out too long, markets could turn even more volatile.
And let's not forget liquidity. If uncertainty continues, banks and financial institutions may become more cautious about lending. We've seen this before. Credit conditions tighten, companies slow hiring, and consumers start feeling the squeeze. It doesn't take much for a debt crisis to trigger a broader economic slowdown.
And look at how major corporations are reacting. Businesses that rely on government contracts, defense firms, infrastructure companies, and healthcare providers are already warning about potential disruptions. If the Treasury is forced to delay payments due to a prolonged crisis, entire industries could see cash flow problems.
And then there's the global reaction. If investors abroad start questioning the safety of U.S. debt, they'll demand higher yields, making borrowing even more expensive. China's U.S. Treasury holdings are already down to $859 billion, its lowest level in 12 years. If that trend accelerates, the U.S. will have to rely even more on domestic buyers to absorb its growing debt load.
And that's where things get dangerous. If foreign demand for treasuries weakens too much, the Federal Reserve could be forced to step in and buy more government debt. That's exactly what Japan has been doing for years, and it's led to decades of stagnation. Could the U.S. be heading down the same path?
That's the trillion-dollar question. And the answer depends entirely on whether Washington gets its act together before markets lose patience.
So what happens next? Does Washington have a real way out of this crisis, or have we already crossed the point of no return? That's what we'll break down in the final segment. So where does this all end? Is there a way out of this crisis, or are we locked into a financial spiral that only gets worse?
The truth is, Washington has only three real options. One, they could cut spending massively to bring deficits under control. But with an election year coming up, neither party wants to make unpopular cuts.
Two, they could raise taxes, but that's just as politically toxic. And even if they did, tax hikes alone wouldn't be enough to close the gap, especially with rising interest costs eating up more of the federal budget every year.
And then there's the third option. The one no politician will admit out loud, letting inflation run hotter. If prices rise faster, it makes the debt easier to pay off in the long run. The problem? That would crush consumers and businesses with higher costs.
And none of these solutions are quick fixes. The debt crisis isn't just about this year. It's about whether the U.S. can sustain its financial dominance in the coming decades.
The warning signs are everywhere, and the clock is ticking. Gold is hovering around $3,000 as investors scramble for safety. China's U.S. debt holdings have plunged to a 12-year low, rate $59 billion, and Treasury yields are creeping higher as uncertainty spreads. Meanwhile, the Federal Reserve is caught in a trap: cut rates and risk inflation, or hold steady and risk pushing borrowing costs even higher. This isn't a future crisis. It's happening now.
So, what happens next? That's up to Washington. Will they find a real solution, or will they just kick the can down the road again? Either way, markets and the global economy are watching closely.
If you want exclusive insights, breaking financial news, and expert analysis delivered straight to your inbox, sign up for our newsletter. It's the best way to get ahead of the markets before they move.
Before we go, remember that the information shared in this podcast is for educational and informational purposes only. It should not be considered financial advice. Always conduct your own research and consult with a licensed financial advisor before making any investment decisions.
Mergers, acquisitions, and geopolitical shifts carry significant risks. Political uncertainty, economic instability, and regulatory changes can impact markets in unexpected ways. Always analyze the broader implications before making major financial decisions.
Music in this episode, including Not Without the Rest by Twin Musicom, is licensed under the Creative Commons Attribution 4.0 license. Finance Frontier AI Copyright 2025. Unauthorized reproduction or distribution is prohibited.
That's a wrap for today. Stay sharp, stay ahead, and we'll see you next time for another deep dive into the forces shaping global markets.